All right, good Tuesday morning, investors and traders. My name is Seth Golden on behalf of Finom Group. Welcome to our latest video. As usual, none of this is scripted. I thought I'd wake up here on Tuesday morning, late in the September seasonal cycle, as the markets are still under pressure, pretty much expressing the typical September seasonal swoon, which actually starts in August and lasts through most of September. Right now, as we wind down the month of September and the seasonal pattern, if you will, we are in the weakest portion of the seasonal stretch, which is the final 10 trading days of September. And so I know a lot of folks are kind of contemplating and wondering if this is the worst, or is it going to get worse? Are markets going to come under that much more pressure going forward? As usual, no predictions. Nobody can predict the future. Anything can happen in the marketplace. But if you look at that through the lens of we are all on an equal playing field, nobody knows what's going to happen next. That's actually the beautiful thing about markets. We know what's going to happen long term, but in the interim, there are a lot of different variables to consider. So with that said, we're going to look at a series of oversold conditions in the market, utilizing the S&P 500 as our benchmark to identify just how oversold, if indeed markets are oversold at all, through various different stochastics associated with the S&P 500, as well as put-call ratio. So with that said, we'll look at a few charts here, and we're only going to look at technicals, if you will. We're not going to be discussing the macro. And you said, well, Seth, there's so many macro headlines out there. Why should we only be focused on technicals? And the way I would answer that is first and foremost, you shouldn't. Let's not presume that that is all we should be doing, is focusing on technicals. In my opinion, the way that I've learned the markets over time is that fundamentals come first. They are the driving force of the market. They produce the actual technicals that we are looking at via charts. Having said that, from time to time, the headlines surrounding the fundamentals, or the macro fundamentals and geopolitical, they are nothing more than headlines. The financial media needs something to talk about on a daily basis, and we are a global economy. And fortunately, the global economy gives the financial media a lot of fodder for which to consider on a daily and weekly basis. And you can really trip yourself up consistently, finding yourself dependent on those macro fundamental or geopolitical headlines that more often than not lead to nothing. They are just kindling, if you will, for the firestorm that is the financial media. So with that said, in front of you see our first chart here. And as annotated within the chart, the S&P 500 is 2 standard deviations below the 50-day moving average. So if we consider we're looking at the interim time frame, that's why I pulled up this chart with the 50-day moving average, considering our key moving averages from top to bottom. You might say the 20-day moving average, the 50-day, the 100-day, and then the 200-day moving average. So for the interim trend, we're looking at the 50-day moving average. Are we in an uptrend? Are we in a downtrend? Again, that depends on your time frames. Longer term, if we're thinking of the 200-day moving average, the slowest moving average or stochastic, we are still in an uptrend. From the October lows, we are definitely in an uptrend, but the interim trend has pointed down since the peak in late July, or the very end of July. July 31st was the peak of the market here in the 2023 calendar year. But recently we have fallen below the 50-day moving average, and we've even undercut ever so slightly the August closing low. So we have a swing low is what they call that. Is that the end of the world? No. Does it make for a lot of headlines for a lot of nervous investors? Absolutely. But with that being said, what I've also highlighted in these circles is the different occurrences for which we were not just below the 50-day moving average, but 2 standard deviations below that 50-day moving average. At the same time, at the bottom panel here, you have the Bollinger Band percent, B, which identifies various times that we reach these, what I would call deeply oversold levels. In other words, we are trading below the lower Bollinger Band. And when that typically happens and coincides with trading 2 standard deviations below the 50-day moving average, we are typically identified or characterizing the current market conditions as oversold. More often than not, the market rallies in short order within a number of days, not weeks, but days. So that's what's being identified in this chart. But these are just, 2 oversold conditions. There are a litany of stochastics that will identify oversold conditions. This in and of itself, to Seth, is just a couple of oversold conditions. I would like to see more because this happened really quickly. We had a 2-day sell-off in the S&P 500 through the FOMC meeting last week and Thursday's trading session that brought about this oversold condition using these stochastics, if you will. So now we're going to look at another oversold condition, or the achievement of the oversold condition, which hasn't been had yet, and does suggest there could be more downside to come in the market. This chart right here is the S&P 500 percent of stocks above their 50-day moving average. So the number, the percent of stocks trading above their 50-day moving average. Historically, you want in a healthy bull market, in an uptrend, an interim uptrend at least, more than a majority or more than 50% of stocks will be trading above their 50-day moving average. Now, when you get, and that's why I identified or used this white line here to kind of identify typical oversold conditions using this particular stochastic. And quite frankly, we haven't reached it yet. Once you get to about 15% or even worse, 14%, 13, 10, not single-digit percent of stocks trading above their 50-day moving average, you are deeply oversold, and you should prepare. How do we prepare for an oversold bounce? By buying stocks. But we haven't reached that level yet. As of yesterday's close, as of Monday's close, only 21% of stocks are trading above their 50-day moving average. Is that bad breath? Absolutely. It's just not so bad that it's hit that oversold. Now, is this a requirement to be oversold? No. The market can still rally, even though we haven't hit this oversold condition. What we're trying to identify here is just easy setups, easily oversold. And that would be identified by the white line. It gives you more confidence to buy that dip, buy that correction, buy that pullback when you achieve this level of oversold condition. So not quite there. I wouldn't call this no man's land, but it does suggest that investors might anticipate that much more downside to achieving that oversold condition. So again, this is the S&P 500 stocks trading above their 50-day moving average. Next one we have is the McClellan oscillator for the S&P 500. Now, in the past, you may have seen my post or my tweet where when we get to the negative 100 level on this particular stochastic to identify oversold conditions, over the last 4 years, when you get to negative 100, The market has rallied at least 4% all but one time. The last time that we got to negative 100, what happened? We rallied 4%. So it's been very consistent. Now, this is one right now, as of yesterday's close, it's at negative 55. You could suggest this is in no man's land. Coming into this week, it was at negative 76. But with yesterday's somewhat rally, if you will, we got less oversold by the McClellan oscillator stochastic. It's easily oversold when you get to negative 100 or greater, as it was on this particular day back in August. Right now, this one, you could make the argument, is in no man's land. Not quite oversold yet. So the McClellan oscillator for the S&P 500, S&P 500% of stocks trading above their 50-day moving average. We're looking at the interim trend, looking for those oversold conditions. Should we anticipate a bounce today, or should we anticipate maybe another leg down in the market? Our next oversold condition, if you will, this is looking at, as I mentioned earlier, the put-call ratio. We're looking at the equity-only put-call ratio by the CBOE. And what this is identifying, it's not just the put-call ratio, but the 5-day moving average of the equity put-call ratio. Historically, whenever this gets to 0.75 or greater, and as you can see, as of yesterday, it's at 0.80, you've been forming a bottom. It is a buyable low in the market. It doesn't mean the low is in. There may still be more downside, but it's still a buyable moment. It's an oversold reading. There's a lot of fear in the market. People are buying protection. Even though the put-call ratio itself, all right, so at the bottom panel, as we can see here, having a little trouble with my recording here. Earlier this year in January, we can see that the 5-day moving average of the put-call ratio got above 0.75. And indeed, if you had bought that dip, good on you. Market traveled higher. Back here in March, during that somewhat mini correction, 5-day put-call ratio, 5-day moving average of the put-call ratio gets to above 0.75. Indeed, that was a market low. Once again, back here in May, although a minor blip, for the S&P 500 in this longer-term uptrend, once again, 5-day moving average of the equity put-call ratio gets above 0.75. That was a buyable low. More recently, August, above 0.75. Buyable low, multi-day rally, nice profit if you had bought that particular oversold, more fearful low in the market. Again, above 0.75 with a big spike in the put-call ratio itself. And we had a 2-day rally there to relieve some of those oversold conditions. So again, right now we are above 0.75. In the for the 5-day moving average of the put-call ratio, suggesting that we are at least making a low. We're bottoming out here in the seasonally weak period. It doesn't mean we've hit bottom, but we are bottoming out. or basing, as some people would like to say. Here's another chart. This is the bullish percent index for the S&P 500. I've drawn these horizontal lines to mark the variance between overly bullish behavior in the market or sentiment versus a reading down here where you have overly pessimistic, if not bearish sentiment in the market. So as you can see, when we get above 70 for the bullish percent index, when you get above 70, that's usually, too much froth in the market, overly confident investors, too bullish, and within days or weeks, we're in the midst of some type of corrective or pullback in the market. Here in the past, above 70, we can draw our horizontal bar, and we can see that was a peak there before a bit of corrective activity. This is the S&P 500 in the bottom panel. Again, above 70, that was a peak there. We get some kind of corrective activity. Now here, below 30, right, overly pessimistic, overly bearish, we tend to get a rally. The degree of the rally largely depends on the market regime. Are we in a bear market? Are we in a bull market? Have we gone too long without a correction or pullback in a bull market? A lot of that depends on a lot of the rally off of this negative reading here or bearish reading here will depend on the market regime. Once again, below 30, major dip in the market, but we rally off of that type of oversold bearish condition. Here again, we get above 70, and we can see that was a peak in the bullish sentiment and the market, August of last year. So right now, where are we? Well, unfortunately, and as you can see, the annotation defines where we are using the bullish percent index. Right now, we're in no man's land. Right? We're not overheated. We're not overly bullish, but we're not overly bearish either below the 30 level. So for this particular one, we can't say that the market is oversold. Again, we're using various stochastics to identify oversold conditions. So far, based on the stochastics that we've looked at, we do have one oversold condition, but this one, not quite, the McClellan oscillator. Again, this one, S&P 500% of stocks above 50-day moving average, not easily oversold. This one here, using the distance between the 50-day moving average and the actual S&P 500 price, is oversold. Bollinger Bands, oversold. So we have some oversold conditions, but others suggest that we are in no man's land, that there still may be one more leg down in this market. Now, last but not least, this is the consumer discretionary relative performance to the consumer staples. And we're using the equal weighted version of these ETFs or industries in the marketplace. Why consumer discretionary and consumer staples? Because these tend to identify what type of market regime we are in. Are we in a defensive market or are we in an offensive market? Are we in a cyclical market or are we in a risk-off market? I think what you can tell already by this chart is that even though we've gone through this, what is now or what has been a 6% pullback in the S&P 500 and 8-9% pullback in the NASDAQ, equal weight is still in a longer-term uptrend channel here. And we are currently trading at the upper end of this channel. Now, this is calendar year 2023, starts right here. We can see also that the RSI has been in an uptrend as well. It's hard to suggest that the market is defensive, that we're in the throes of possibly a new bear market, and that sentiment is so bad when you still have an uptrend in consumer discretionary relative to consumer staples. Not only that, we're making a series of higher lows throughout this cycle. And this particular pullback in the overall market, we didn't even get back to this more recent low. So for all the headlines and all the macro concerns, government shutdown, UAW strike, the Fed, right? China not doing so well. Our market indicators, especially when it comes to risk on versus risk off, are we in the throes of a new bear market forming? You would typically see consumer discretionary greatly underperforming consumer staples if investors, the wide swath of investors, were concerned about a possible new bear market. With that, hope everybody enjoys their trading week. We'll see you next time.